Hey folks, it's Rob Flux here with another Sunday session, and today is a little bit different. We've got the most boring topic humanly known to man, preparing for tax time. I guess we are coming up to the end of financial year, and so it is timely to talk about all things tax, which I understand is boring as batshit. But it's the things that you need to know that are way more important. And so what I'd try to do today is to give you some insights in what it is that you need to know in prepping for tax time and also in going into next year, understanding how it is that you want to set yourself up and the like. So now, given the nature of the topic, it is super, super important that I do this disclaimer, basically to say I'm not an accountant, I'm not a financial planner, I'm not a solicitor. I cannot legally give you any advice in and around this. What I'm giving you is my insights and my knowledge to try and help you along the way. And hopefully what that will do is educate you enough so that you can go ask a better question of your relevant, accountant and or solicitor as and where appropriate in doing this. And obviously there are some many complications in this particular topic. So we're going to try and dumb it down a little bit, not dumb it down, simplify so that it's a little bit more tangible, a little bit easier for you to grasp. That will then allow you to then go and ask your appropriate, accountant and or solicitor, what it is that you need to do in order to move forward. So now that said, there is a bucket load of stuff in here. So we need to understand what taxes might actually start to apply. And there are many taxes and lots of confusion in and around this space when it comes to property development, and a lot of misconceptions. Now, as I said, I can't give you advice here, but I can give you an opinion based on where my experts have actually told me over time. And hopefully that will give you some insights into what it is that you want to start to talk about. Now, there are lots of different kinds of taxes. There's capital gains tax, there's goods and services tax. There are issues and challenges around goods and services tax. So there's a BAS, a business activity statement. There's margin scheme. There's company tax rates. And company tax has then PAYG, pay as you go. And then you finally have some income tax. So depending upon what it is that you're doing, it can get really messy. And also depends on how you're doing it. So what I thought I'd do is I give you 5 simple steps that are going to simplify this down. And it is a simplistic overview, okay? But if you follow these 5 steps, it should give you some insights in what it is that will apply, where it will apply, etc. So step number 1, what is it that you're about to do? Okay, so if you are investing, then it's more likely that capital gains tax is going to apply, okay? So I'll go into what capital gains tax is in a little bit later, but investing is more likely capital gains tax. Now, if we are developing, it is more likely that goods and services will apply. So GST will apply, okay? Now, for the majority of this presentation, I'm going to assume that we are developers listening to, the Property Developer Network because you're wanting to learn the property development process. So I'm not going to go huge amounts into the investing side of things, but I will touch on it just for completeness of this particular conversation. So firstly, what is it we're going to do? And for the majority of us, that is going to be development. Now, I'll touch on that a little bit later because there are instances where I have heard a number of people attempting to use capital gains tax when they are trying to do their own developments. Now, there are anecdotal, instances where I've heard people trying to do that and trying to use it as a one-off exemption. Now, the challenge that you might face here, and I say might, and it's really important that you actually ask your accountant if this will actually apply, but you might get away with doing that the very first time. But if you then go and do a second development, maybe even a third, then the ATO is at some point is likely to look back on you and say, well, you've got a pattern here of doing property development. I think that the way you actually did the first one was actually, with the intention of making, money out of that process through the development process. And so they can potentially go and retrospectively apply that. So you want to be really careful if your intention is to use the capital gains tax kind of loophole, for want of a better word, that you want to be really cautious how you use that because it can come back and sting you later on. So make sure you get really good legal and accounting advice on that one particular one. But at a very simplistic level, investing, capital gains tax, developing, GST, okay? So the next question you want to ask yourself, step number 2 in the process, how do we intend to exit the deal? Now, this is important because depending upon how it is that you intend to exit the deal, you might set up a completely different way of structuring the deal from an entity perspective. So there's asset protection reasons why you might want to set up an entity, and there's also tax implications as to why you want to potentially sell this, set it up in a particular way. And so let's have a look at some of those different ways that you might exit the deal. So firstly, you might sell everything. So if your intention upfront is to sell everything, then the ATO is almost certainly going to be charging GST on the sale of not of almost all of them, but it will charge GST on the sale of those finished products. Now, because of that, how you set up your entity structures might be, I guess, deliberately set up to leverage that in the most appropriate way. And I'm not going to talk to what entity that should be, because that starts getting to the advice side of things, other than to say, well, if GST is going to apply, it doesn't really matter if you're going to try and do it in your own personal name, or if you're going to do it in a company, or if you're going to do it in a trust, but GST is going to apply irrespective. So given that's the case, you want to start to talk to your solicitor for asset protection and your accountant for accounting purposes and say, well, I'm going to have GST apply anyway. What's the best way for me to actually set that up? So you might set that up in a very particular way. Also, know that when you're selling the finished product, there's a thing called the margin scheme that you might want to start to apply as well. And I'm going to touch on that a little bit later. But just for now, if you're going to sell everything, GST is going to apply to everything. Okay. If you're going to sell some of the assets, this is the other way to actually exit the deal. You're going to sell some of the assets, then the GST will apply to the assets that you sell. Now, the assets that you intend to keep, well, this is where it starts to get a little bit murky, because the assets that you intend to keep, remember step 1, are you going to be investing? Then the assets that you're keeping potentially could be investments. Now, I say potentially because the ATO have a little bit of a rule as to how long you actually hold those before they convert it from one intention to the other, and you need to demonstrate that your intention is actually there to keep it. So now don't quote me on the exact date, but I understand that if it's for 5 years, if you sell it any time in the 5-year period, then GST will apply. If it's in year 6 and beyond, then it converts over to capital gains tax. And the capital gain is based on the cost base of you actually manufacturing that at that wholesale rate. So if you're going to sell some, then GST will apply to the sum. Now, that's important to know, because let's just have a hypothetical here. Let's just say you're going to do a 6-pack of townhouses and you're going to keep one of those. Then you're going to charge GST on 5 of those and not charge GST on the 6th one because you're keeping it. That means every single invoice you've kept along the way, 5/6 of that you can actually claim the GST credits, and 5/6 and 1/6 you can't because the GST didn't apply. So you need to think about that right up front. Always start with the end in mind, understand how you want to exit the deal, and think about that all the way. Now, if you're going to sell none of them, this is the third way you might want to exit the deal. If you're going to sell none of them, then again, chances are, depending upon how long you hold them for, if you get past that 5-year mark, it might revert into the capital gains tax. But if you sell it inside the 5 years, almost certainly GST is going to apply. So you want to start to think about right at the start of the deal to say, well, how am I going to actually exit? So if I know how I'm going to exit, that might change how I set up my entity. It's going to change how I do my accounting. It's going to change how I do a whole bunch of things. So think about that right up front, folks. Don't get to the very, very end and then try to make up your mind which is the best way to actually get out, because at that point, you've probably done a lot of your bookkeeping in a, I guess, inappropriate way that might mean a whole bunch of rework. So you want to, I guess, save your bookkeeper that, you want to save your accountant that, you want to save yourself all of that extra hassle and the extra cost that actually is associated with that. So that's step number 2, how do we intend to exit the deal? Step number 3, then how long will we actually hold the assets? Now, this is what I touched on before. If you're going to keep some, or if you're going to keep all, then that 5-year period is what's actually going to kick into place. So now remember that there's going to be a whole bunch of elements that's going to happen along the way. So if you're going to hold for a long period of time, then you're going to potentially have land tax implications that happen depending upon the entity that you're actually going to put it in. So land tax has a very specific key date that if you own an asset on that key date, then you'll get land tax applied. If you don't own it on that key date, then you don't. So now that key date changes in each state. So for Queensland, for example, that key date is the last day of the financial year, so the 31st of June. If you're in Victoria or in New South Wales, then that key date is the last day of the calendar year. So that is the 30th of or 31st of December, whichever one actually applies. So if you own the asset on that day, land tax applies. If you own it the day after, so if you pick it up on the 1st of January, for example, in New South Wales, then you didn't have land tax apply. So you get almost an entire year with no land tax. So you want to start to think about how long you're actually going to hold the asset as to what taxes are likely going to apply in that period. Okay. Now, as I said, if you are going to hold an asset for less than 5 years and sell it, then almost guaranteed GST is going to apply. So know that that's the case. And the reason is because GST, if you want to claim the imputation credits, and I'm going to talk about imputation credits a little bit later, but if you want to claim those imputation credits, you can only back charge those or back claim those for 2 years. So if you're going to hold it, let's just say that you're going to hold it for 4, you had a whole bunch of expenses that happened in year 1 that you may not be able to get those imputation credits for. So you want to think really long and hard how I'm actually going to do this, because you might want to claim that GST, the imputation credits right up front. And then when you go to sell the asset in year 3 or year 4, then you can actually offset one against the other, as an example. Okay. If, however, you're going to keep it for 5 years or more, then it's almost certainly going to convert over to capital gains. Now, that can get a little messy. Hopefully that was something that you're all able to follow in that process. So that's step number 3. How long are we actually going to hold the asset? Step number 4, what entity are we actually going to do the deal in? Now, there are many different ways that we can actually do a deal. So you can do it in your own personal name. You can do it in a company. You can do it in a trust. You can do it with a trust with a corporate trustee. You can do it with a company that's owned by a trust. You can do it in a trust that's owned by a company. So there's lots of different combos in actually how we can actually do this. So rather than getting really confusing, I'm going to kind of dumb it down very simplistically and basically say, look, there's really only 3 primary entities that you need to really concern yourself. 1, you, the human, okay? 2, if you're doing it in a company, and 3, if you're doing it in a trust. Now, which entity you do that in is going to change how the tax is going to apply. So very simplistically, if you do it in a trust, then the trust is what they call a pass-through asset. That is, the trust passes the money through it, and the ultimate beneficiary is the one who actually pays the tax. So if the ultimate beneficiary is a human, then it would come through to income tax. If the ultimate beneficiary is a company, it'd go to company tax. If it's the ultimate beneficiary is another trust, then that other trust then inherently might actually also have a further further beneficiary further down the line. So in essence, we've really narrowed it down now to 2 entities that you really want to start to worry about, and that is you, the individual, and I guess whether or not you actually do it in a company. Now, I'm not going to get into, I guess, as I said, I can't get into advice mode, but what I would caution you on very, very strongly is that doing something in your own personal name is just crazy, folks. And the reason is anytime you're actually doing any form of construction in any way, shape or form, there's going to be an ongoing warranty liability that comes with that particular property. And the person that you sell the property to has bought that from you. So their claim is on you. You then have a claim against the builder. So you want to make sure that in that particular instance, you don't know if the builder's going to go broke. You don't want to get in the middle of one lawsuit where they sue you and then you have to go sue the builder. So doing it in your own personal name is kind of crazy to kind of put yourself at risk, put your assets at risk, put your house at risk, all those sorts of things. Be very, very cautious about doing your own personal name. That, and if you do it in your personal name, you'll see in a moment the tax rates that apply there might be a little bit higher than you would actually like to pay. And so I guess the other alternative is to do it in a company. Now, company would have a company tax rate and I guess a whole bunch of other obligations that have come through there. So I'm going to go through each of those individually in a sec, just to kind of break those out in a little bit more structure. But I guess the most common thing that I actually see out there is that people will actually do their developments either in a company or in a trust of some description and pass it through to, a holding entity of some kind. They're the things that I tend to see most often. Now, whether that's right for your situation or not, I guess you need to make sure that you've got both your solicitor and your accountant giving you the right advice on that. But be very careful, folks. I guess that asset protection is super important. And then where are the proceeds going to end up? This is step number 5. Where are the proceeds going to end up? So there is the entity that will actually do the work, and then the entity will push the profits down into an ultimate repository. That ultimate repository might be, as I said, it might be another trust. It might be yourself as an individual. It might be, split across many, many individuals. It might be down to another company. It might be all sorts of things. So where it's actually pushed down then becomes another, place for tax to potentially apply. So they're your 5 steps. I'm just going to loop through those one more time so that's nice and easy to catch. So step number 1, what is it that we're going to do? Are we investing or developing? Step number 2, how do we intend to exit the deal? Make sure you understand that right up front before you enter the deal, because that will change what entity you might actually potentially set up. How long you intend to hold the assets. Again, know what that exit strategy is and what your intention is for how long you're going to keep it, because again, that might change the entity that you actually put it under. Okay. What entity do we actually do the deal in? And that's going to be formed by the answer to questions 2 and 3. And then lastly, once the entity has finished doing the work, where are the proceeds actually finally pushed through to that ultimate entity? So they're basically your 5 steps. Depending upon how you answer those 5 steps will completely depend on what taxes are going to apply, in what order they're going to apply, and all sorts of things like that. Crazy, crazy stuff. Now, that said, let's have a look at the 2 kinds of tax that right up front. So capital gains tax or GST, which one should actually apply? Now, the ATO looks at this very much at intent, okay? So if your intent is to be an investor, then it is capital gains tax that is almost certainly going to apply. If your intent is to run what they call an enterprise, then GST is likely to apply. Now, the ATO put some very, very clear and stern warnings on this. And what they deem to be an enterprise, they repeatedly say this one phrase, okay? And I want you to really have it sink in and register. They consistently say, even a one-off property transaction may be an enterprise, okay? Now, because of that, what they're really trying to say in very lay terms is GST is almost certainly going to apply to almost everyone except some very, very rare instances. So you want to make sure that if you're trying to claim your CGT, that you have actually had that sounded off by your regular accountant to make sure that they're actually giving you sound advice in that regard, and that you're not just doing that because you talk to a mate down the pub, okay? So super important of that, okay? So make sure that you're super clear on that. Now, when you need to register for GST, well, that's another matter altogether. So you need to register for GST at the point where your gross income, not your profits, your income exceed $75,000. Okay, so as soon as your revenue turns over more than $75,000. Now, let's have a look at it, folks. The reality is that almost any property that you ever sell is almost certainly going to be greater than 75,000, which means that it's going to be very, very rare that GST would not apply. Okay, so I want you to be really cautious on that and make sure that you've thought that all the way through before you actually, I guess, try and do that. Now, when it becomes due, well, that's at the moment you know that the 75,000 is actually going to come in. So I guess when you have a contract of sale that has absolute certainty that you have the money about to hit the account, that's when you must register for GST. Anytime up to that, where you haven't yet got that guaranteed income, you may potentially, and this is again, talk to your accountant on this, you may potentially have a situation where you can say, well, I'm not sure if I'm actually ever going to get the sale. So you have the option to register for GST early if you feel it's actually appropriate. Now, for some projects that are small in nature, you might find that the overhead of actually doing that, registering early and doing all your BAS obligations, that sort of thing, you might think that the obligation is a little bit too hard for the benefit that it actually returns. But as you get bigger and bigger in projects, it can actually be a benefit to actually register for GST, claim some GST credits back, that sort of thing. And so you might optionally register early for all sorts of reasons that your accountant will actually go into. Now, let's try and have a look at what actual tax rates are going to apply. Remember those 5 steps that actually are going to go through. And I'm going to start at the bottom of the totem pole. So at the bottom of step 5, okay, at the bottom of step 5 is who we're actually going to distribute it to. So if you're going to distribute it through to you as a human, as an example, then us as humans have a thing called income tax rates. Okay, so most of us are used to that from a day job perspective, but it's a tiered tax structure. So I guess there are 5 tiers that actually start to apply. You've got the first $18,200, which is no tax at all, 0 tax. So if you are fortunate and you don't have any other income stream at all, then the first $18,200 is tax-free. Okay. After that, after $18,201 up to $45,000, and that's recently gone up, that is 19 cents in the dollar. Okay, so quite a low tax bracket for anything below 45,000. After 45,000 up to 120,000, that jumps up to 32.5 cents in the dollar. So that's only for anything above that 45,000 mark. Then between 120 and 180,000, that jumps up to 37 cents in the dollar. And then over 180,000, it's 45 cents in the dollar. So the more income you earn, then the more tax you will actually pay on everything that goes above the next threshold, above the next threshold. And so if you're looking to try and minimize your tax, then one of the things that you could do is start to look at, well, where are you from your day job perspective or any other income stream that you're actually looking at? See what tax bracket you're in and see, well, if I distribute money to me down below, is that going to potentially trigger me up to another tax bracket? Now, if that's the case, do you distribute it to you, or perhaps you've got a spouse or other family member or something like that that might help you to distribute so that those profits out in a couple of different directions to, I guess, not breach those thresholds. Now, they're things to consider. Some people have lots of people in their family that they can actually do that to. Other people have nobody because they're actually doing all this by themselves. And so you might want to consider, well, maybe I don't need all the cash in my pocket. Maybe I don't distribute all of it this year, but maybe what I might do is think about, do I distribute that over multiple years? So remember, you're going to have a project that is lumpy in nature. You might have a project that runs for 2 years. 1 year, you're going to have this massive income stream, and the next year you're in between projects and you've got no income stream. So you might want to think about, do I want to smooth that income out over multiple years? Maybe I pay myself half of it this year and half of it next year to kind of smooth that out a little bit. And if you do that, that might keep you underneath one of those tax thresholds. So you're not paying maximum tax 1 year and no tax the next. So you want to start to think about that. Talk to your accountant about, how do I start to smooth my income out over many years? That will, I guess, keep more of the dollars that you earn as dollars in your pocket. And that's really, really important to actually understand. Okay. Now, in going through those, so nil, 19 cents, 32.5 cents, 37 cents, and 45 cents. So know those numbers, folks, because when we start to look at our next entity, the next entity is companies. Now, a company, and I'm going to assume in this instance that we're talking about a smaller company. There are, larger companies like Telstra and BHP and things like that trigger into different tax brackets. But there is a thing called a base entity tax rate, or a base entity company, and that has recently changed to 25 cents in the dollar. So depending upon whether or not you distribute all of that money through to you, the individual, if you keep some of that up in the company, you might pay less tax if you keep it in the company. Then there's a whole bunch of things to say, well, if I drip feed that over many years, I've already paid tax this year, and then I distribute it down to me next year, that a lot of that tax has already been paid. There's a thing called franking credits to say, well, if I've already paid some of the tax, I might be able to offset that. Now, I'm not going to go into that in super detail, other than to say that there are ways to smooth out that income and potentially keep your tax at a lower bracket if you don't need all the cash today. Now, many of us are really tempted to say, look, I want all the cash. I feel comfortable that it's in my pocket. I can put it against my mortgage. I can do all those sorts of things. But if you are triggering up into the higher tax bracket, so if you're up in 45 cents in the dollar kind of tax bracket, well, you're throwing away a lot of tax that might be unnecessary. You might be able to instead be able to keep that in, a company where you're paying a lot less tax, and consider that smoothing it out over many years. Look at the savings that might actually be achieved there and see whether or not that's actually worthwhile. Your accountant can help you do the math on that to see whether or not that's actually going to save you money off your mortgage, for example. Now, company tax rates have changed many, many times over the last few years. I'm not going to go into it in super detail, but they have slowly been ratcheting down. They used to be 30 cents, and then they went to 27.5 cents, then they went to 26 cents. They're now 25 cents in the dollar, okay? So it's quite an effective regime to actually keep your money in a company. But there are some catches in that. I'm going to try and touch on some of those catches that we're going to potentially come to. Now, let's have a look at, well, when is your tax actually due? So whether you are a company or whether you are a person, irrespective, your tax is due at the end of financial year, right? Now, that sounds like a pretty obvious statement, but if you have a project that finishes today, for example, end of financial year is only 2 weeks away, and so then your tax becomes due really, really quickly, though you do have some time to actually lodge that and to go through that process, and I'll talk on those timelines. But if, for example, you were able to delay the settlement by 3 weeks and you land in the first week of the next financial year, you can't physically lodge a tax return until the end of that financial year. So you might have anywhere up to 3/4 of the year, maybe 90% of the year, that you defer your tax. Now, the tax is clearly going to be due. You have to pay it. There's no avoiding the fact that that's actually going to happen. But are you potentially able to park that money, repurpose it for that year, maybe use 100% of the cash to be really, really effective during that year, knowing that you need to get it back in time to pay the tax? Super important, okay? So timing, when your settlements actually occur, you might make some really clever decisions about, hey, I don't want to settle in 30 days, I want to settle in 45 days instead when you're negotiating the sales contract, because when the money arrives is super important, okay? So if you're in the process right now and you've got some settlements that are due any day, see whether or not you can actually ask them to push that out a couple of weeks. That might save you a bucket load of, you won't save you the tax, but it might give you the ability to utilize that, money in the short term until the tax is actually due. So that's the first part. Second part is, irrespective of when the end of financial year happens, there are a couple of timelines that actually start to trigger. So if you're lodging for yourself, if you, the human, are lodging your tax return, then you have till the end of the first quarter in order to lodge the tax return yourself, okay? That is because the ATO says, well, if you're lodging it yourself, you can control your own destiny, no problem at all. So you should be in a position where you can actually lodge that yourself. Now, the majority of us don't lodge our own tax returns. Majority of us go and use an accountant, which means that the accountant has a lot of people coming in and asking for their tax returns to be done all at the same time. So the ATO has said, well, for anyone that goes through an accountant, that when it's due actually gets extended because the accountant has to do lots of tax returns for lots of people. And so they give 3 quarters, so Q1, Q2, Q3, the end of Q3, in order to lodge the tax returns if you're going through an accountant. That again is really important because again, that if you can defer until the end of financial year and then defer again for another 9 months, then you might potentially have a potentially anywhere up to say 18 months where you've earned the cash, the tax is due, but the tax hasn't been paid, it's been deferred that period of time. You might be able to repurpose that cash in the short term so long as you can actually get it back in time to actually pay. So it's a good way to actually think about, how do I actually improve my cash flow? What are the things that I can do to make my life a little bit better? That sort of thing. Now, that's irrespective of who does it, whether it's a company, whether it's a trust, whether that is an individual. Those timelines start to apply, right? The other thing that I would, and remember those key dates that I said before about land tax as well. So depending upon the state you're in, you might again defer to choose to either settle early if you're doing sales so that you avoid the tax, or purchase late if you're, purchasing so that you actually miss that key date and actually don't pay that land tax. So that's super important that you actually understand your timelines and what key dates actually trigger and that sort of thing. So key dates for land tax, depending upon your state, will be the end of the calendar year or the end of the financial year. Key dates for tax returns are clearly end of financial year, plus 9 months if you're going through an accountant, okay? So those things are super important. Now, let's assume for, everything up until now, it doesn't really matter if you're a company, a trust, or an individual. If, however, you are a company, then what the ATO says is, hey, you had no cash, no income, and all of a sudden, you've just given me a rush of cash in one big hit. So you've had all this massive profit and massive income all come through in one hit. The ATO says that's really hard to manage. We can't predict if that lumpy money is going to come through all the time. And so they've got a thing that they call PAYG, pay as you go, where they say the ATO wants you to smooth that out over the entire year for next year. So the first time you lodge it, PAYG hasn't applied. But once you've lodged it, the ATO says, well, we're going to assume you're going to earn the same amount next year. So we want you to start drip feeding that out over many years. Now, when you read the ATO's website on this, they position it as if they're doing you a favor, okay? So some of their words are, something along the lines of whether you run your own business or earn investment income, planning ahead to do your income tax is important to help you keep a healthy cash flow. Pay-as-you-go installments will help you to do this. Well, I'm saying, look, ATO, no matter how fluffy you make it, the reality is what you're doing is you're imposing on me a cash flow burden. And so you're making me pay tax in advance when I actually haven't got the revenue to fund that. Now, you need to know that up front, because effectively what you're doing when you get the first lot of tax for the end of year one, you're paying that tax return, plus you need to put aside into your piggy bank enough cash to then drip feed out another round of cash for an entire year. So effectively, you've got to put aside 2 years worth of tax for the very first time you do a company tax return. That can be quite a burden for you. And a lot of people get caught out on that one because they don't put that extra cash aside. Now, if you are, closing the entity down, never going to lodge a tax return again because it was a one-off deal, then that PAYG doesn't become a problem, okay, because you've closed the entity down. However, it can be quite problematic because in many instances, even though you have no intention of running another deal in that entity, you can't actually close it down until you've lodged your final tax return. And so putting that money aside, that PAYG might actually still be triggered to get to the final tax return, where you then claim that back. So you may have to give it to the ATO and then claim it back at the end of financial year. So it can be quite a burden from a cash flow perspective. It's one that catches many, many people out many, many times. So be very, very careful in doing that. Now, I'm just going to take a small sip. Now, assuming that you're doing this in a company, and as I said, we tend to see a lot of people actually do things in a company. Remember I said, once you earn more than 75K a year, you must register for GST. Anytime prior to that, you can select whether or not you want to. So you can optionally do opt in. Now, if you do, every single quarter, there is a thing called a BAS, a business activity statement, which becomes due. Now, what a BAS is it's a little bit of a true up for the ATO to help you smooth out your cash flow. Now, I'm going to try and help break down GST a little bit because it is a little bit confusing. GST is ultimately what they call a pass-through tax. That is that it passes through your business onto the next person, until finally, the last person, with the musical chairs, the last person with the last chair is the one that ends up paying the tax. So let me explain how that works. So you might go and engage a consultant. The consultant will give you an invoice, and that invoice will have GST associated with it. Now, that GST you must pay upfront, okay? Because the consultant who gave you the invoice must, pass that through to the ATO along the way. If, however, you then charge somebody else for a service, you can then use that GST you paid to that consultant as a credit towards any GST that you need to pay later on. So that's called an imputation credit. So what a BAS does is it allows you to say, look, I've already paid this GST to someone else, but effectively I'm going to use that to a credit towards my own GST. Now, you do the ins and outs of that through your BAS, and it allows you to claim back some of the GST that you've paid along the way. So remember, you're going to be paying your town planner, your architect, your builder, your civil engineer, all of these consultants along the way. They're going to give you these invoices that have got GST attached to them. All of that is tax that you have paid in advance that you may be able to go to the ATO and say, hey, I'd like to claw that back, please, and put that in my pocket. Now, at some point in the future, you're going to sell a property and you're going to have to give it back to the ATO in a different form, okay? But you might be able to use that right now as cash flow, okay? So you might consider that if you're doing a small project, the mechanism, the amount of GST you've paid is probably not a huge amount. The burden in actually doing that BAS return might be a little bit because you've got to pay a bookkeeper, an accountant, do your own, accounting internally in-house. You might say, look, the actual record keeping of that for a small project might not be worthwhile. So a 1:2 subdivision or a new duplex or something like that, you might go, look, it's too much hassle, right? But if you're starting to do bigger projects, you might go, do you know what? That cash flow is really important to me. I might claw that back. Yes, I'm going to give it to the ATO later on when I sell the property, but it's going to help me right now to say, look, I've got money in the bank. I can actually pay other invoices in the short term. So know that that is actually, an opportunity for you to electively register for your BAS, and that any GST that you've paid to any other consultant is called a imputation credit, so you can actually offset that against your any future invoices. Now, once you've registered for GST, it's a must that you must do your BAS on a quarterly basis. So the 14th day of every single month, you must do your BAS. There is another option that you might choose to do. And the option there would be to say, well, I don't want to do it quarterly. My project is actually large enough. I actually want to do it monthly. Now, if that's the case, that might help you even more with your cash flow. Now, the day changes. So that's going to be the 7th day of the month, not the 14th day of the month. That's going to help you massively to improve your cash flow. But again, it's more accounting, it's more bookkeeping. So, you want to make sure that the project actually justifies the end of that. Now, when is your tax due from a BAS perspective? As I said, it's only you must register for GST the moment you know you're going to earn 75K. Okay, 75K in revenue, not in profit. Now, you can argue, I don't know if that's going to occur if you've not actually put the property for sale, because you don't know if the builder's going to go broke. You don't know if the market's going to change. You don't know if you're actually going to get it to market. You don't know all sorts of things. So you can potentially be able to be in a position to say, well, the only time that I know that revenue is going to come in is the day I've got a sales contract that actually says this property is sold. Anytime after that, GST is mandatory. Anytime before that, it's optional, okay? And then remember, once it's registered, it must be quarterly, but again, it's optional if you want to do monthly. So you've got a few different moving pieces that sit in around that might be, I guess, beneficial to actually understand. Now, GST is the finished product that you're actually selling. There are only certain property types that GST will start to apply in. Remember what GST stands for: goods and services tax. So if we have created a good or created a service, then there is a tax for that. And because of that, that's a nice, simple, easy thing to remember. So if we are creating brand new land, if we're creating a brand new house, if we're creating a brand new townhouse, we are creating new goods, okay, which means that GST will apply. If, however, you're reselling a second-hand house, so for example, you might have found that the existing house has some intrinsic value, you might cut down the size of the land and then resell that second-hand house. Well, you've not created a new good because that good was already there, and the previous person who created it probably paid the GST. So a second-hand house, GST does not apply. Now, there is one little catch on that, and that one little catch is unless you substantially renovate it. Okay, so if you substantially renovate it, then you are effectively recreating a brand new house again. So substantial, there are some good definitions on the ATO website. However, what I would be saying to you is if you are not doing anything structural, it is unlikely that it would be deemed to be substantial. If you are doing anything structural, so if you're extending the house, or if you're lifting the house up, or if you're adding an extra room, if you're doing anything structural, make sure you actually go and get some really good, clear advice to see, is this substantial enough to trigger that it's actually going to be paying GST? So knowing that GST is going to apply, GST in its purest sense is on the sale price of the finished product, okay? So so whatever that finished product is, it's 1/11th of that sale price, or I guess the gross realized price of that particular property. 1/11th is GST, okay? And so if you just pay that GST, that's a huge burden on your cash flow, and it's a big hit. But there is a little trick that you've probably heard of called the GST Margin Scheme. And if you're able to do the GST Margin Scheme, then it's not GST paid on the sale of the finished product, but rather on the margin between what you bought it for and the uplift that you actually created it, because that's the part where the goods and the services were actually applied on that uplift, okay? Now, the problem is that many people, A, get confused by the margin scheme, and B, don't know how to actually claim it. But that margin can make a very significant difference. So let me give you just a very simplistic example. Now, this is a fictitious example. It's not real numbers. I've just kind of kept it nice and simple for ease of explanation, okay? So let's just say that we buy a block of land for $500,000, okay? And we do $500,000 worth of improvements. So the total cost to us is $1 million, okay? We're going to sell that for 1.5 million. Then in that instance, the GST would apply on 1/11th of 1.5 million. So quite a large amount of cash, okay? However, remember that we bought it for 500K, And so the margin between 500K and 1.5 is only 1 million. So instead of paying 1/11th of 1.5 million, we could have instead been paying 1/11th of 1 million, which is that margin. Okay. Now, it's not as simple as that. There are a little bit more complications to that, but I want you to just get that simplistic baseline, because that cost base, I guess the margin that we're basing it on, is really subject to, well, how many pieces did we carve it up into? Could we keep the existing house? Could we not keep the existing house? There's a whole bunch of what is the margin of what. Okay, the accountant will actually help you to determine what that baseline price is, where that margin is actually deemed. But effectively, we don't have to pay all the GST on the complete sale price, but rather we get a discount on that. Plus, on top of that, we then get to claim the imputation credits. So every piece of GST that we've ever paid to I guess a town planner, a civil engineer, an architect, the builder, all those sorts of people, those GST imputation credits, we then offset that. And so the GST, whilst it is quite a significant number, we then offset by the margin, then we offset that by our imputation credits. So the GST that we actually pay is much, much less. And so it can be something that is very clearly easily confused, and also causes lots of pain to people who don't understand, and they don't get it right in actually calculating their feasibility. So really important that you actually understand how you do that. Now, I'm not going to do the math on all of that for you. You can do those examples for yourself, okay? Now, the GST on the sale of the finished product, I guess, is claimed by the ATO at the point of sale, okay? So when you sell your property, the ATO has a thing called the GST withholding tax. So that is at the point of settlement, the ATO just goes and grabs the GST that they believe that is owed to them at that point in time, and you must lodge your BAS statement to say, hey, based on I guess our calculations, you've taken too much money or not enough money, or however that is, and you're going to do a true up, I guess, the next time you lodge your business activity statement, okay? But know at the point of settlement that the ATO is just going to take that. So depending upon, I guess, whether you're going to claim full GST or whether you're going to claim the margin scheme, how much tax they take at the point of settlement, I guess, will change. So if you're doing, I guess, pure GST with no margin scheme, they will take 1/11th of the entire revenue at the point of sale. If, however, you're claiming the margin scheme, they'll take 7% of the contract price at that point in time. They will take that, put that into the ATO's coffers, and you must then go do your BAS statement, do the true up and say, look, these are the credits that was actually owed. This is the tax I should have actually paid. And you do a true up, and the ATO will then give you back, I guess, the outstanding balance. Really important to understand that, because you might be counting on that cash coming into your pocket and then later going to pay that out. Instead, it goes straight to the ATO, so your cash flow gets impacted. Now, it never used to be like that. It actually only came into effect a couple of years ago. It used to be that it came to you first and then you had to pay later. But a couple of dodgy developers would actually get the tax, close down the company, what they call phoenixing. They would actually close down the company and go, sorry, guys, we don't exist, never pay their tax. So the ATO said, well, we're not going to have that anymore. We're going to take I guess, the GST right up front. Okay, so the practical implications are that you're going to have some impacts on your cash flow in how and what you do, because the cash has already left your account, whether you realize it or not. It's already gone there. So you have to claim it back in order to true up that. So if you know that you've got other outstanding bills and you haven't got enough money in the pocket, make sure that the point of settlement, you're not counting that in your cash flow, because you may not get it back for 3 months, depending upon if you're doing quarterly BASs or monthly BASs. Okay. So all of that's important with regards to your cash flow side of things. But then there's, well, what record keeping do I actually need to do for all of this? Well, the ATO insists that you keep 5 years worth of tax records, folks. So that is every single document that you need to prove that transaction actually occurred. So that is any contract of sale, any records of any calculations with regards to how you determine the margin scheme, any proof points, any invoices that you receive from suppliers, all those sorts of things need to actually be kept for 5 years, okay? Now that's super important because it must be kept in a way that if it's just paper on the shelf, what happens if your house burns down? The ATO don't care if your house is burnt down. They care that did you keep the records? So you need to have a process in place to say, well, am I actually, so I don't want to have a shoebox. I want to start to scan those records and actually put them somewhere safe, store them somewhere on a cloud, all those sorts of things, okay? And because of the ATO's record keeping obligations, a lot of the online accounting platforms actually have a document management process as part of that. So you can scan the invoices and upload that into all your accounting packages and that sort of thing, and they will keep your compliance for you in an ATO compliant document register, okay? So know that you need to do that. Don't just keep it in a shoebox and hope, okay? Really not a good idea. Now, if you do have a shoebox, there are places where you can post your shoebox and they will actually scan all the documents for you, and using a technology called OCR, optical character recognition, it will actually read the invoice and it will actually calculate who was the person that the invoice was for, what was the amount it was actually paid, what was the GST, and they'll actually upload all of that for you electronically. So know that those companies actually do exist and that you can post a shoebox out to them and they will actually do that. I guess when you haven't done your records for quite some time, that's probably a worthwhile service. Depending upon how many records you got, it might be a couple $100, but trust me, it is much better than you spending 2 or 3 days or maybe even a week scanning every single document and giving it a save name and then trying to read, is the scan good enough, that sort of thing. Post it off, pay someone else to do it, outsource that responsibility. Is going to be super, super important in how you actually do that, okay? Now, if your intention is, as I said, you've got to keep your records for 5 years. But remember also, I said, if your intention is to keep the property for a period of time, and if it's inside of the 5 years and you want to sell it, remember GST will apply, but there's a loophole that says, well, whilst you need to keep 5 years with the records, you can only claim your GST from memory for about 2 back years, okay? So note that there are some challenges in and around that. So even though you've got the proof point, the ATO says, too bad, so sad, you snooze, you lose, we're not going to take that anymore, okay? Now, if your intention is to use the margin scheme, it is super, super, super important that you must have written proof that the purchaser that is purchasing your property off you is aware of your intention to claim the margin scheme. Typically, you're going to do that in writing in the contract of sale, okay? So you would have a special condition that says, hey, I'm not going to give you the exact wording, but hey, my intention is to use the margin scheme. Please be aware that this price is inclusive of the GST that I must pay and the fact that I'm going to be using the margin scheme. Now, don't use those words, right? Make sure that your solicitor actually writes the words for you, but know that you need to put it in a contract of sale. If you don't put it in a contract of sale, it might be possible for you to beg the other person to sign a letter that actually states that. However, it creates some really, really challenging conversations in trying to do that. They're going to go, I don't understand. I'm just Joe Public. I don't pay GST. Why are you getting me to sign something about GST? It's confusing. I'm not sure. Hey, it's going to save you a whole bunch of tax. If it's going to save you money, what's in it for me? I want a piece of the uplift of that. So you want to try and avoid all of that right up front. Get it into the contract. Get it clear. Have no point of confusion. Have no chance for them to say no. Have no chance for them to actually ask you to share half of that uplift. All sorts of things like that, okay? So make sure you get it written into the contract right up front. Super, super important. Now, here is one that most of you out there will have absolutely no idea about, okay? So super important if you're still hanging on to this call right up to this point in time. There is a thing called TPAR, the Taxable Payments Annual Report. Now, a TPAR report must be registered by the 28th of August every single year. Now, a TPAR report is a list of every single consultant and or person that you've used in the building and construction industry, you must do a report on them and give that to the ATO. So you must say, look, I used Bob the Builder. I paid him this amount of money. I paid it on these dates with these number of invoices. And this is how much GST that he charged me at the same time. So you need to do that for every single one of your suppliers, okay? And every single one of them, that one report, that TPAR report, then gets lodged to the ATO. And then Bob the Builder needs to do a TPAR, and Bill the Brickie needs to do one, and Jane the something or other, Jane the architect, needs to do one as well. So if they're in the building and construction industry, everyone needs to do this by the 28th of August. And then what the ATO does is they do some data matching, and they say, well, you said that you paid Bob the Builder. Bob the Builder did not say that he received any money. Hey, Bob, you're in trouble. So if you don't lodge it and Bob the Builder does, then all of a sudden in the data matching side of things, you're the one in trouble. And so it's a really great opportunity for the ATO to say, hey, it's time for me to come and give you an audit because you haven't been keeping your records up to date. So make sure, if you want to minimize your chance of actually getting an audit, make sure you do your TPAR reports, okay? If you're using online accounting packages, then many of them will automatically, so if you're doing your regular BAS statements along the way, you're keeping all those records anyway. A lot of those online packages will automatically have a TPAR feature in there. So make sure you're choosing a platform that actually does do that. In doing so, there are lots of accounting packages online, okay? So there's Xero and MyOb and Attaché and a whole bunch more, okay? But most of them will actually have that TPAR. Make sure you get that signed off upfront when you sign up to actually use that platform. Equally, those online cloud accounting packages will also have the ability to do the document management, so you can upload your invoices and that sort of thing and account for all of that. So super important that you do that. Okay. The other thing that you need to do, I've already touched on this, you've got to keep 5 years worth of records. So that is every single contract of sale, every contract of purchase, any variation, anything that at all, the settlement statements, anything with regards to that transaction that you're going to use in order to justify your position, you need to make sure that you're actually documenting along the way, okay? So in doing all of that, summary of all of that, folks, summary of all of that, please do very good, I guess, document management side of things. Make sure you're on top of your invoice tracking and that you're processing that on a very regular basis. What I tend to do is I have a document naming convention. So I know that every single invoice is dated. I know exactly who the supplier is. I know what the purpose of it is. I know what the amount of it is. And that goes into the name of the document. I then upload that into, I guess, my online accounting platform, which then my accountant also has access to. So I have a bookkeeper who does the accounting side of things, and then the accountant can touch into that and go, okay, well, we can see that the bookkeeper did all the right things. And then the bookkeeper and the accountant can actually then ask questions, and they're looking at live data as they're going. So super important, okay? The other thing that is best practice, okay, for every single project, now I personally use Xero, but there's Xero, MyOb, Attaché, that sort of thing. Doesn't matter which platform you use, they're all going to be much of a muchness, okay? They're going to give you the same sorts of features and benefits, so I'm not kind of recommending one over the other, but make sure that you set up a brand spanking new file with that accounting platform for that one project, okay? Start the file for that project, close the file at the end of the project, okay? Don't try to confuse many projects together, because your bookkeeping then gets messy and horrible and the like. Have a brand spanking new bank account for that one project. So any single invoice, any single bill, any single payment goes in and out of the one bank account. That one bank account links to the one accounting platform. So it becomes really simple to say this transaction is for that project for this reason, and you've got an invoice to match it. It makes your life super simple. Don't complicate it by trying to combine many projects into the one file. It's going to create a nightmare for you. Trust me, in the early days, I did that, and it is not fun to try and unravel that. Please don't do that. Make sure that if you're doing that, that you're doing I guess those uploads and the invoices and the I guess the reconciliation of that, make sure you do that on a regular basis. Typically, if you're doing it yourself, you might do that either weekly or monthly. That then means that when you get to the point of doing your BASs, the work to do that is super, super simple. Most of those online accounting platforms just have a magic button that says, hey, lodge my BAS, okay? So again, makes it super simple. You get your accountant or your bookkeeper to sanity check that you've uploaded everything correctly. Your BAS becomes nice and simple. Okay, we don't have to overcomplicate it. The days of doing it in Excel spreadsheets, guys, are over. Please don't do that. You're just creating more work than you need to. The cost of these online platforms are $20, $30. They're per month. The headache that you are saving by trying to do that in an Excel spreadsheet, it is not worth it. Trust me. Whatever hourly rate you're on, you're probably doing many hours by tracking it in a spreadsheet. Just pay the money for the online platform. It's going to make it so much easier. Okay, that is kind of all that there is on what you need to do to prepare for tax and the end of financial year. But in doing that, I want to have my opportunity to have a rant, okay? So let me have a little bit of a rant about taxes. So if you are any government organization listening this far into my spiel, let me tell you that the reason why the cost of houses are going up so much is that nearly between, depending upon which state you're in, between 25 and 40% of the finished product price is some form of hidden tax. Let me touch on some of those hidden taxes that are actually sitting here. When you purchase the property in the first place, there's stamp duty on the initial purchase. When you sell the property, there's going to be GST on sale of the finished products. There's going to be GST on the construction, on the consultants, on the inspections, through the entire process, every single consultant that you lose along the way. There's going to be land tax that's going to apply for the life of the project, and that land tax is going to be at a higher rate because of the fact that you're almost certainly going to do it in some form of entity structure for asset protection, which means a company or trust, and so that land tax is higher. Equally, the rates, you're going to pay rates along the way, and equally, those rates are typically higher because you're trying to do it in some entity that's going to protect yourself. You're going to have finance fees where you have to register a mortgage and release a mortgage, and titling fees and all sorts of things. You're going to have water, sewerage, and other authorities having headworks charges. Typically, they're going to have an application fee to actually assess your application. Then there's going to be an installation and then a headworks fee along the way. Sometimes there's even a compliance fee doing that. There's building application fees, building approval fees. There's environmental levies. There's Telstra NBN, those sorts of connections. There's also all of your electricity applications and connections and approval fees. Council hits you many times. They hit you for rates every single month along the way. As I said, that's higher because you're a developer. There's council contribution fees or infrastructure charges, depending upon where you're headed in the country. There's operational works application fees. There's operational works approval fees. There's inspection fees. There's plan sealing fees. There's a whole bunch of fees. Council, stop it. There's building and inspection fees. Depending upon the state, there could be anywhere up to 15 inspections along the way. There's going to be bond for certain works that you are creating that you're handing over to council as an asset. So if you're upgrading their sewer line, if you're upgrading their stormwater, if you're building a road, if you're doing those sorts of things, you might have to create a bond that you hold for 12, sometimes 2 years, 12 months or 2 years, that sits in the council's coffers waiting to see whether or not there's actually any warranty claim on that, and eventually they give it back, but you have to cash flow that along the way. There's titling and easement fees when you actually go and create the tiles and easements. There is stamp duty that's sold to the ultimate purchaser. So we paid stamp duty on the way in, and now the next person coming in is going to pay stamp duty as well. And remember, we're creating multiple products, so there's multiple stamp duties. If we create 6 somethings, then there's 6 more stamp duties along the way. And then if you happen to be a foreign person purchasing, then there's the Foreign Investment Review Board stamp duty uplift. Oh my goodness, that's a lot of tax. I cannot believe how much actual tax is sitting in there. It is insane, folks. So that's the end of my rant. Now, I'm just going to see if there's any questions that have come out there. That's been a lot of stuff me going on. So I guess let's see if there's anyone out there who I guess has got any questions. Now, I can see Simran, for example, says, how does the entity names work if entering a joint venture? If I'm the money partner, what do I need to be mindful of? Simran, I cannot give you any advice here, I'm afraid, mate. I guess I'm talking educationally here to say what taxes will apply and how to actually go and talk to your accountant and ask better questions. I can't give you advice on how you actually do your entity names. What I can tell you is that I tried many, many different ways of doing my entity names going back in time. In doing that, I probably caused more confusion than I really should have. And so I've probably changed the naming convention that I use many, many times. I'll tell you the one that I use right now. It's much, much simpler. If I'm doing a project at 123 XYZ Street, then I do an entity that's called 123 XYZ Proprietary Limited. And depending upon if I'm going to keep that at the end, then I might do that as trustee for the 123 XYZ Trust, as an example, right? And so that way, the likelihood of that company name being used at ASIC is very, very low. So the ability for my accountant to know that property belongs at that address is really, really simple. I haven't got some, Rob's investment structure 1 equals, property at 123 XYZ Street, and I have to remember that. My accountant has to remember it. It causes all sorts of mayhem. So I'm going to say keep your naming convention super simple. Now, what the entity is, that's a different matter altogether, okay? That is very much what your accountant has to say. Let's see, is there, Anthony from Goma Property says, who is the company that scans all of your tax invoices? Mate, I'm assuming that you're referring to the, the shoebox side of things. I have used one in the past who strangely used to call themselves Shoeboxed. They have now renamed themselves and they call themselves Squirrel Street. Now, I don't know why Squirrel Street. It doesn't have a logical name to it. I have used them for many years. They are great for catching up your backlog of everything that's actually sitting there. Know that that is possible to actually do that. Let me see what other... Sorry, guys, I'm just seeing what other questions are sitting out there. So Cherie says, I understand GST does not apply to be a going concern, i.e. rooming house. Do you know about this, Rob? So again, can't give advice, Cherie, but I guess what you're talking about is a going concern being a business where GST is already being charged along the way. So my understanding is, no, it is not charged. So be super, super careful that they're not adding that. And so when you buy the contract, that they're not actually adding that in. Now, if they have, so let's just say that the contract says GST inclusive because they weren't smart enough to actually remove that, I would personally remain silent on it, wait to the point where it actually goes to settle, and then go back to them and say, hey, can you please give me an invoice for that GST that you just charged me? That then becomes an imputation credit for you. It's one of those things to be aware of, but it might actually be a hidden opportunity in the process. Sam says, if you pay GST as a company before registering for GST, e.g. for consultants and builders, can you accrue these costs to offset the GST you need to pay for the registration? The answer is, Sam, yes, it's absolutely possible. But in order to claim that, you need to backdate your BAS, okay? So, for example, let's just say your project runs for 2 years. You've got 2 years worth of invoices that actually sit there. And then all of a sudden you go to register at about the 18-month mark. You need to go back and do all the BAS statements for every single quarter for the entire 2 years, okay, in order to claim those back. So yes, it's possible, but remember you can only go backwards for 2 years. So be super, super careful about how and when you actually do that. So Sydney says, is it best to create a new company for each project? Again, can't give advice, Sydney. However, me personally, I do, okay? And the reason for that is because it creates a much simpler accounting structure. It creates a much simpler asset protection structure, creates a much simpler finance structure in trying to go get loans, and a whole bunch more. But that may not necessarily be what is best for you, okay? But for me personally, that tends to be what I do. I would be talking to both your solicitor for asset protection reasons and say, look, I don't want any ongoing warranty obligations that sit past the you don't want the foundations of the house to sink or the roof to leak or anything like that. You don't want to claim on you. And then the other thing is, how do I want to do my tax return? So that the two are going to fight with each other. You go ask your solicitor for one piece of advice, he's going to say one thing. You go as the accountant, and he's going to say something else. The two don't necessarily meet. So you want to make sure that the two of those people are in the same room at the same time. They might recommend a blended or a hybrid structure that might actually help you out. But no matter where it lands, it's where the tax always lands at the bottom is where the ultimate tax is actually paid. So that's going to help you along the way. Anyway, folks, having a look at what other questions are there, that's pretty much all I can see. So thank you for, I guess, listening to such a riveting topic for you today. And I can't wait to see you at the next meetup. Next one is in Sydney. And remember, we are literally months away from our 10th birthday, folks. And we're going to have a party in every single state all the way around the country. So if you are, I guess, a regular contributor, or sorry, regular person that attends our meetups, then make sure that you come for the next couple of months and find out how we're actually celebrating for the entire year and your ability to potentially win anywhere up to 50 holidays we're giving away for our 10th birthday, folks. So can't wait. I can see a few thank yous coming through. So thank you, folks. It's been a pleasure, and we will catch you all at our next one. So thanks, folks. Bye for now.